You might as well fire it up, it's gotta be getting close. Okay.
I mean, not that it mattered, we had it done fine, but...
I'm watching the download there. My download speed, I can't watch it because
Schmidt?
Wait, pause.
Schmidt? Paul? Bill? Hanson?
Get from it. Public comments, anybody got public comments on it? Randy.
About the only thing this month is we got the county audit back, and there's a pretty good credit in there, 4,400. So payroll down a little, and the telling you're getting really credit because you've had good experience. That's the way it is. What I do have. That would do a lot of good things.
Was that the UCCI thing?
No, that's just the workers' comp.
The workers' comp credit? Here's
So-
the...
Oh, actual credit,
Yeah.
not just the number for percentage.
The actual payroll at the end of the year, they reconcile, they come in December and reconcile your actual payroll costs to the estimates they use to determine our premiums.
So, two things can affect it then, is the actual amount of payroll going out, which is the big player, and then also the percentage that is...
How many lost?
Right.
And then there.
It'll be interesting to see, don't you think, this next year what happens with our rate. I'm anticipating a tick up since we've had someone out on workers' comp since October.
My experience depends a lot on whether they're paying, whether it's back surgery, expensive. It's the fact that somebody out, doesn't affect it as much as how much they're paying that person. If it's a lot of medical or health, that's important to their salary.
It is salary, but we also have replacement. Yeah.
Thanks, Randy.
Kind of mind on next time.
Yeah, 95%.
You have reported any major right now, we're at 0.77%. We ended the year at 11.94. The norm is usually 18%. So we do
Yeah, but I think that's higher than what historically we were, right? Weren't we typically, I think we were around 6 to 8% after the 4 year. Double check that for us,
I will.
because it seems like it's ticking up.
Okay, I'll go check on that, we need to look at something that we can for the next
Right.
5 years.
Right.
Other than that, it's been good. But just want to give you that, we can always update your report, usually each month too, that's what we have over the time we really focus on it.
Right.
Okay.
Good. Thanks, Susie.
You're welcome.
Okay. We're up to this,
My turn?
your
Can I do that short? Yes. No problem for everyone? Even with all this paper in front of you? Okay. I think I've met all of you before. My name's Hope Wheeler. I'm principal with Clifton Larson Allen. I brought Ayla Grady with me today. Ayla's the senior that was in charge of the field work out on site, and she's just kind of here to see how it all works and observe. But we may ask her some hard questions. I brought drafts today, so it's not the bound final copies that I think we've done both here before. Just wrapping up some final items, getting your guys' approval. We need a letter from the state's attorney to finalize, and then this will be ready to be issued, and then we'll send you all the bound copies. But then don't anticipate any changes unless there's a surprise in the state's attorney letter, which I don't anticipate. So I put together this year, rather than trying to flip through these reports, I put together this summary that I'll go through. There are 3 different reports that we issue as a result of the audit. And this is for audit 11/30/15 fiscal year end. The first is called the governance letter, and that's on page 3 of the presentation. I'll just go through some of the highlights from the governance letter. And this is a communication that's required to a finance committee or a board just to go over certain segments of the audit that under your governance we feel we have to share. Accounting standards say we have to share this information. So the first bullet point there is significant accounting policies. If there was anything new adopted this year, there was this fiscal year. This was a big year of implementation for a new government accounting standard, or GASB 68 and 71. We've talked about those the past couple of years, that those were pending, and those related to net pension liability for IMRF being actually, rather than just a footnote disclosure and required supplemental information disclosure, it's now actually a liability, and then there's an asset too associated with it on your financial statements. And it does make a pretty good difference, as we'll talk about as we go through the numbers. There are 2 footnotes that you can refer to. Note 9 in the financial statements is all the new required disclosures related to these new GASBs and the pensions. It's quite lengthy now. And here it gets lengthier because it's not just one disclosure. We have to disclose some separate information about regular employees, elected official plan, and then the sheriff's plan. So it's somewhat repetitive information, but for all 3 of those. Then note 16, also I wanted to refer to because as you implemented this new standard, they don't want to just come up with these new numbers and put them through the current year, so they came up with numbers for the beginning of the year too, and so it restated the beginning fund balance numbers, and note 16 explains that restatement of the beginning numbers for this new pension standard. The second bullet point is significant accounting estimates. Sometimes, especially on a modified accrual basis of accounting, there can be estimations in the accounting process. You haven't really had significant estimates in the past, but this year I want to point out that this net pension liability related to IMRF is a significant estimate. It's based on expected salary increases, inflation, life expectancy, required contributions. I mean, it is definitely a significant estimate. And so that also means it can swing each year, as Anita and I have talked about. So the basis of that estimate is disclosed in all of that footnote information. The next bullet point is corrected and uncorrected misstatements. Basically, this is referring to where there are adjustments as part of the audit process. There were a few adjusting entries this year, mostly related to receivables and revenues and deferred inflows. Those are attached to the copy of the governance letter. We went over those with Anita and got on the same page, made sure we agreed with those. A lot of that stems, and we'll talk about this more later, but a lot of that stems from it getting a little more difficult as funding isn't received as timely now. So there's some estimation process of what's going to come in and when, and we're out here pretty early, so some of this hasn't even come in yet. So that's what triggered some of those adjusting entries. And then, 2, there was a new confirmation process that was confusing last year related to, I believe it was motor fuel tax. So there was a receivable that should have been recorded last year that got missed. So that's part of those adjusting entries. The past adjustments mean there were some items that we noted that were small enough that they didn't get posted to the book. We summarized those and attached those to the governance letter. And as long as they stay small enough, they don't have to be posted. The larger one of those, honestly, was related to IMRF, and IMRF had a rough year too with the implementation of this new standard, and their actuarial reports weren't accurate. And then later they came out with audited information that was different, so then we had to try to reconcile the two, but they weren't going to go back and pay for all the actuarial studies to be redone. So we had to reconcile between the two, and it's easier to use the actuarial information because it has all the required components. So that's supposedly going to be all straightened out by IMRF next year, and the two reports should agree and not be so complicated. The last two items, disagreements with management or difficulties encountered in performing the audit, we want to share with you as the Finance Committee, but we did not have disagreements regarding, financial reporting matters or auditing procedures, and we didn't have any significant difficulties encountered in performing the audit. In fact, we're hoping you all noticed that we're here a month earlier than normal. Normally we're here in April, so we're happy about that, and thank you to Anita for being prepared for us and helping this happen. Okay, now to go over some highlights of the large financial statement report. Just to hit on a few highlights. Obviously it's a lengthy report and I'm not going to touch on each page, but overall the audit opinion is in the front of this, and this is a clean, or it's called an unmodified opinion. So we feel like these are, in all material respects, are fairly stated financial statements in accordance with generally accepted accounting principles. One difference this year is that your federal expenditures didn't exceed $500,000, so we didn't have to do the A133 single audit. So there is no single audit report in here. We still did the audit in accordance with government auditing standards, so there's still a government auditing standards report, but no single audit report. You look confused. So this is federal expenditures over $500,000 was historically related to FITHC and federal grants. And now that we're just Iroquois County, the grant amounts went down and put us under the threshold. We anticipated being under the threshold for FY16 because the standard will change this year, and it will go from a threshold of 500 to 750,000. So we thought, I was thinking, excellent, next year, easy. Only once we got here, and like day one, day two, we still didn't know if we were going to be over or under, but based on all the confirmations and everything, but it turned out that we were under. That's really significant in terms of the work that the auditors do in actual testing some of those grants.
Should save us some money next year then, huh?
It will save us some money this year too. Yeah, it did.
So going from big business to small business, basically with the federal government, because of that one department, how it was changed. The mechanics of it, basically.
Mm-hmm. Dropped you below that threshold.
Makes sense.
Just so these guys understand, getting this done earlier, explain that. Getting it done earlier helps our numbers be more accurate earlier.
I was trying to explain this to Kevin earlier because he came in and we were kind of talking about the challenges, and I talked to Hope yesterday about having them come out a week later next year. Some of the things with the estimates, some of the things. I had several mistakes, things I didn't catch. The 911 telephone tax, I booked it for the totally wrong amount. But I'm so stressed out, and I'm doing it so quickly that I'm slamming things in and I'm not comfortable. I don't have time to go back and double check and triple check like I like to make sure I have everything, one, that it's complete, and two, that they're all accurate. So we want to have them come a week later but still try and hit this March time frame. Kevin was questioning whether we really want to do that and put more pressure on me to get it done quicker. The longer you delay, this is my opinion from my experience in accounting. The longer you delay and you have that outstanding, then I'm not reversing all these accruals from last year. The expenses in December are sitting in December because I haven't reversed the accruals. It just gets so complicated to try and look at this year when I don't have everything from last year, all the T's crossed and the I's dotted, and we're done, and we can move forward. Once we got to the point that I had all the adjusting journal entries from the auditors, then I can go through and reverse last year's accrual, book NIDA's depreciation expense, and really put that FY15 to bed. And so while it's challenging to try and get it done quicker,
there are advantages to it, and I think, for me, the advantages outweigh the difficulties in getting it done.
There's some, to add to that, there's some accounting policies about receipts and when they come in after year end, and then whether you record that as a receivable or you defer it to the next year. And right now you have a 60-day policy, and we're here before that 60-day policy is even up, so it becomes difficult to make those adjustments and know those adjustments.
Right. I'm estimating, what we're saying is, for the modified accrual, okay, if we get the receipts within 60 days, I'll book it as a receivable. Well, we book it as a receivable either way, but as revenue in FY15. We count it as revenue received, right? But all of a sudden, by January 31st of this year, we didn't get really any of the money other than motor fuel tax and 911 that I did the accruals for from the state. So all of a sudden, all of those had to be reversed back out of revenue and booked as deferred revenue for next year. It's just way too complicated. So I was going to wait and talk about that after Hope gets finished. We talked about changing that window of 60 days to 6 months so we can make good faith estimates of when money's coming in, book the entry, complete the audit using those good faith estimates, and be done with it, and not have this, it literally got crazy, really frustrating.
And in theory, it does a better job of matching up those revenues than with the related expenditures, rather than the revenues being the next year because they were after 60 days.
So like all the salary reimbursements we got for all of last year, and I'm kind of taking, Mindy was probably going to talk about this in her department stuff, but we got all the salary reimbursements for Bob, for the state's attorney, for probation salaries. The first group of checks came in February 2nd. We got it like the 3rd or the 4th, and the next one like the 8th. Seriously, they paid all of them. All those accruals, because they're after January 31st, by 1 week, had to then be reversed, and those are audit adjustments. It's like, seriously? Very frustrating. Very frustrating.
It's all part of the strange governmental accounting rules of modified accrual versus full accrual financial statements.
When they first come up with this GASB stuff,
Exactly.
I asked my person PA about it. He said, well, you got to swag it. What is a swag? He said, a scientific, wild-ass guess. Why would they do that? It just doesn't make sense. But it's coming around, I guess.
And, you know, because the funding is getting later and later, I think the idea of changing the policy, because you have the right to set your policy at 60 days or later. You can't be swinging it up and down every year to adjust it, but if you have good reasons to change it, you can talk about that and consider changing it to make your record keeping more consistent.
Right, so what's going to happen is all those salary revenue lines for last year are going to look atrocious. And this year, depending on when we get the funding, if we get all the funding in fiscal 16 that relates to 16, it'll be a huge swing from way down to way up. Not just, I mean, the big thing is going to be for public health. All those grants, those state grants, are going to look atrocious. They have all these expenses for payroll and everything in fiscal 15, and they got no revenue after July. All of those got reversed to deferred revenue. Theoretically, they'll all get paid this year. Who knows what's going to happen with this year? But now you have a mismatch, and that is against accounting.
The red flag.
It's not GAAP. GAAP is you match revenue with expenses, and we're not doing that now. But I think, as Hope and I talked, it could be the nature of the beast moving forward. This may not be a 1-year
Delayed
anomaly.
Yeah.
Okay.
But we,
Okay, I'm sorry, I interrupted you.
No, but
excuse me if I may. So it's very difficult to keep revenues that was supposed to be put in 015 in 015 and expenses that, the expenses are easy to keep where they belong, but the revenue side. And to avoid that, I don't see how shortening the window would help then. The window of our closing, like our 60-day window we got now.
she's going to lengthen the window from 60 days to maybe 180 days.
Right.
So then if
Okay, that would
if
make
it comes
more sense
in
then.
after January 31st, not that we're going to wait and do the audit after the 180 days,
Right,
but if
right.
it comes in February, then it's a revenue and it goes.
It's within my 180 days.
It gets recorded.
And I'm not swinging things back and forth, and we don't have the mismatch. It's giving the state more time to pay us. Really.
I like the short window if I was doing the job, because I'd say it's done at this point at the 60
Right,
day,
right.
but at the same time to keep things accurately hitting where it should in given fiscal years, yeah, you need a bigger window. When, yeah, I guess you call that modified accounting when we
Well, it is called
stretch out.
modified accrual.
Yeah, modified accrual when you start, yeah,
Mm-hmm.
since we can't just send them to the state's attorney for correction.
Yeah.
Okay. Thank you.
Okay. Sure. Then just to go through more of the financial statements, the next section is in the financial statements is called the management discussion and analysis. Anita prepares that. I didn't reference the page numbers. I think it's page 4 through 8. That's a good section to read because it summarizes all of this financial information and it shows it comparatively from last year to the current year. The next section of the statement is the government-wide statements. That's on pages 9 through 11. That's what I was mentioning where for government entities, you have to show full accrual statements and modified accrual statements. So the government-wide, those two pages are full accrual. So all receivables are receivables and revenue for that. Your fixed asset purchases are pulled out of expense and capitalized and depreciated just like a corporation on the accrual basis of accounting. So on those statements, your total assets and deferred outflows equal approximately $76 million at the end of the fiscal year. The liabilities and deferred inflows are $8 million. The difference between those two is your net position of $68 million. So good, liabilities to assets current ratio there in your net position. So your change in your net position in these statements, which is basically your revenues over expenditures or vice versa for the fiscal year on the full accrual basis, is $3.5 million. But want to explain that almost the entire $3.5 million is related to the pension adjustment. So that new net pension liability that's on the books now is part of these. It's part of this $8 million liability balance that had a $3 million, $3.6 million swing from the beginning of the year to the end of the year. That's in that change in net position number. So after the government-wide statements are the fund financial statements. This is where, these are the ones that are on the modified accrual basis of accounting. So if the receipt is after the 60 days, it doesn't show up in revenue. But these, to me, are a little bit easier to read, too, because it's by major fund. So there, your major funds this year, we have to calculate what your major funds are each year based on certain requirements. The general fund is always a major fund. And just a reminder, that includes the County Information Systems Fund for the financial statement purposes. Motor Fuel Tax Fund is a major fund, IMRF, Highway, Matching Tax, and Iroquois County Public Health. So on pages 12 through 15, you'll see a column for each of those major funds. Then all of the other governmental funds are summarized in the non-major fund column, rather than showing all those separately in the front. Just to hit some highlights, the general fund, since it's the main operating fund, It shows on those pages that for fiscal year 15, there was an excess of revenues over expenses for the year of $194,000, and there's a remaining fund balance of $1.9 million at the end of the fiscal year. And I have some graphs in the back that I'll show you changes in fund balance for the past 3 years. Not to go through each of the major funds then, they're on page 12 through 15, but each of those major funds did have a positive fund balance at the end of the fiscal year. You have no deficit fund balances. And those I have, like I said, I have in the graph and a couple of pages here. The next set of part of the financial statements is the proprietary funds. Those are the more business type funds. Those include 911 and county farm are your enterprise funds. Both of those funds showed revenue in excess of expense for the fiscal year and positive fund balance. There's some schedules in the back, pages 78 and 80, which show each of those funds separately. The front statements on page 17 through 19 to show the county farm and 911 combined. The other proprietary fund is an internal service fund, which is your group health insurance fund, which services the other funds. That fund too, we've talked about that fund a lot in the past too, but happy to say you've continued to now this year make revenue in excess of expense and a positive fund balance. That's the one that used to have a negative fund balance, and you've worked over the past several years to get that corrected, and it's stayed positive. Yeah. The next section of the financial statements is the footnotes. Those are lengthy. Those are page 22 to 48. I won't go through all those, but just some highlights if you want a detailed breakout of your capital assets. That's on page 34 by category, land, building, equipment, etc., construction and process. Note 9, I mentioned that's the new, you always had pension disclosures, but the format of those and the information in them changed, so the new IMRS pension disclosures are in Note 9. And then Note 16 is a unique footnote, and that explains the restatement related to the pension GASB being implemented this year. As I also mentioned, there was a couple of receivables that should have been recorded last year that are shown this year as a restatement at the beginning balance. And then this is a really small one that we determined this year in reviewing the unclaimed bond fund, talking with Anita on that used to be classified as one fund type, a special revenue fund, and it really should be classified as an agency fund. So that's in that restatement footnote also. The next section is the required supplementary information. And this shows a lot more information about the pension, but then it also shows for each of the major funds that are the general fund or special revenue funds, it shows their budget to actual. So page 54 and 55 focuses on the general fund, and so that's the section I wanted to highlight to you there. There you'll see, as I'm sure you're probably aware, but after adjustments and everything, your general fund expenditures were below budget, around $45,000. Supplementary information. As I mentioned, we show all the major funds separately in the front of the statement, but then all the non-major funds get combined. These back statements show all the detail of those non-major funds. So if you want to see a certain fund, you can go back to pages 65 through 77 and find a certain fund and see its balance sheet and income statement for the fiscal year. Same for the agency funds. You can see the detail of all the agency funds, which is funds where you're really just holding money for someone else. That's it for the financial statements. The single audit, the federal reports used to be at the back of them. They're not in there this year as we discussed because they weren't required. So then here I just put together 3 graphs of financial information. This is for the first page 6 of the presentation. This is for the revenues on the modified accrual basis, and this is all governmental funds. So you can see here, the purple is the 2014 revenues, and the blue is the 2015 revenues by major category, the way it's classified in the financial statement. So very high level, but you can see then at a quick glance, a lot of the revenues are very comparable to last year. Property taxes down slightly, charges for services even with last year. Some swings, smaller numbers, but some swings in licenses, permits, fines and fees. Intergovernmental, probably the biggest drop in revenues, but that can be explained easily by the health department. And you'll see it change, those expenses drop down too on the next page. Then on page 7, this is the expenditures by function for all governmental funds. And you can see expenditures were down, the totals were at the top there. The totals on the revenue side, it was $13 million in revenues for 2014 down to $12.4 million in 2015. Well, the expenditures reduced accordingly here. 2014 expenditures were $3.4 million down to $12 million in 2015. Most of the expenditures are fairly comparable with the prior year, some up slightly, some down slightly. General government expenditures down from the prior year. The big drop you can see in the second column there, the health and sanitation, which is going to be that last year had through June 30th FIPHC expenditures, and this year you just have the full year of Iroquois County Health Department. And then the last graph on page 8 is fund balances. Just pick up the major funds here, but then just showed fund balances from 2015, 2014, and 2013, so you can see how they're changing. And some, notoriously do go up and down, don't necessarily stay steady depending on the timing of things. I see that some with county motor fuel tax and county highway. General fund, you can see you've had an uptick in the fund balance over the past 3 years. IMRF has swung up and down some too. That's probably with some different additional payments into IMRF. But a lot of the other funds have stayed fairly consistent from year to year. And Iroquois Public Health Fund obviously didn't exist in this fashion in 2013, so you just have the 2014 and 2015. All right, the last thing I wanted to report on then, or the findings that we found as part of the audit process, and I'll go through those here quickly. Those are in a separate report issued here that you have a draft of. We've already talked about several of these, or a couple of these anyway. There were several adjustments this year that we talked about related to receivables and revenue, including an adjustment to the beginning fund balances related to receivables and revenues. We've talked about those extensively with Anita and think, found ways that hopefully those will be avoided in the future. Part of it's this new policy, maybe moving back the audit and just looking at those next year to make sure all receivables are looked at. The second comment is a repeat comment you've seen in the past, and there's just, with limited personnel in the sheriff's office, there's some inadequate segregation of duties, so you don't have necessarily all the controls over processing and recording of financial transactions there. The next comment is receipts and disbursements for the circuit clerk's office. This year we ran into a couple of items in the circuit clerk's office where in one case we noted an instance in which a defendant paid more than was owed and didn't get refunded. And in another case we noted the fees that are collected that are then turned over to others. In this case it was the fees that get turned over to the county didn't agree with the reports, and it wasn't the amount they should have related to a case being duplicated. Only found those, we have a good sized sample there. We only found one instance of each of these in our sample, but that's just a sample. So there's an internal control issue there of needing to make sure that these items are monitored and reviewed so you can make sure those are accurate in the first go round. And we've touched with Lisa on those, and she's already provided a response with ideas on how to prevent that from happening in the future. We do issue a separate circuit clerk audit. I didn't bring that one with me today. It's done, but that finding's in there with a response to it. The page 10 here is the journal entry support. We select a sample of journal entries to test, and we noted in one instance that the journal entry didn't have documentation supporting the entry for the amounts and wasn't documented as approved by the finance director. Journal entries are just an area of risk because it changes the financial statements without it being a cash-in, cash-out transaction. So we recommend those have a detailed review process and good supporting documentation. There was, in our sample of testing, we noted one claim that wasn't signed as approved by the chairman. And so, once again, that was a sample of one in a group, but that's an internal control issue that we want to make sure, that those are all signed as per the policy, but then also it shouldn't only be paid. Someone should be checking for that before it's paid to make sure all the required approvals are there. The last item is we're required to test for compliance purposes if your bank accounts are properly collateralized according to the statute. And we noted this year that one of the banks held funds that were under collateralized at the end of the fiscal year. So we just need to monitor that, make sure there's enough collateral, or make sure that the cash balances are in line with what collateral there is, or FDIC insurance. Whew, okay. Made it. Ran a little long, but it's a quick summary of a lot of time spent. And if you have any specific questions, we can try to answer those. Or if you look it over and have a question later, Anita knows how to get a hold of me.
I don't think it ran long. I like the way you summarized it.
Good.
It's helpful.
Good. Good to know. Thank you.
I got to think of our IMRF. We've got to be looking better than most people.
This is true.
You know,
Yeah.
I'm a little disappointed because we're still at about 1.9 carry, and I hope to get that up 2.2, 2.4. You know,
We made progress, haven't we?
oh, you got to work with what you got.
And getting some, additional payments in there has helped. Yeah. So it does look good in comparison. And really, I don't see too many that are so debt-free. You know, most of the counties I'm looking at, there's quite a few bonds payable and GO bonds or lease certificates or. So.
Don't have to look that far.
No, I think we're surrounded. I don't know how we're going to do it because I'm worried about it. But we're doing all right.
Thank you very much for the opportunity to work with the county and to come present these. And like I said, we're happy to be here a month earlier, and hopefully we can continue that even with adjusting the timing some. All right.
Thank you.
Thank you.
Okay, where are we at?
Thank you, Hope.
What's his name didn't show up for the recycling, so I think got the bid out.
Sounds good. Dead dog. Leave him a dead dog.
Hey, we have recycling money that we could help with that.
Yeah.
You know. I mean,
Yeah, I had no idea what kind of dollar amounts we were talking about.
well, he was supposed to come back with numbers, he never did.
Well, yeah, you think he would have had a wild sprout with him something. That's what we got the money to pay back for, so it was crazy. I was not supportive until I hear numbers.
Hey, it's his choice. We all got to live with our choices. Department head, Mindy.
The state payment report, they have started to slow down on income tax. We did not receive any income tax payment in February. And we did, as Anita mentioned earlier, we did receive salary reimbursement.
That's good.
Caught up on that, but getting behind on income tax. So, that's all I have.
We're not in any danger level.
Of running out of money?
Yeah.
Oh, no.
I'm sure
But people
thought so,
don't,
but I'd like to repeat it.
you know, it sounds great to say that you got 1.9 carried in
Yeah.
December, but
Goes fast.
it wasn't too many years ago the state owed us $600. Well, that'd bring you down to 1.2. And you just got ugly quick. You know. Anything else?
No, that's all.
Thank you. Nida? Joel?
When's wedding? Cover schedule?
Bob? Well, it's coming quick. Ain't nobody else left. If that's it, the report. Anybody want to discuss the blunt one? That's another dead dog.
I had a conversation with the state attorney because, we've only received the one payment, the new agreement came in place, and he has been in touch with the Blunt, and they're aware of it.
Well, they've been aware of it for 10 years,
I don't think the top priority.
Well, probably 10 years since things like it. All right.
Claims.
Okay, look at the plan.
I have one additional claim that isn't on the claims list. I just got it last night at 4 o'clock, and it's actually the next billing to pay Clifton Larson Allen for the audit. So it's a big one, $13,000 for their payment number 3, and would get us to 93% of the total fee. So since we are essentially done,
I think we should add it.
So you need a motion to get that moved out, do you? Okay.
yeah, you'd want to approve the claims on the list plus this additional one.
I move we pay the claims plus the auditor's claim just to him.
Any more discussion? Got a motion and a second, no discussion? Call the roll.
Yeah. Yes.
Bills?
Yes.
Hanson?
Yeah. Any old business? Come on, guys, somebody got to come up with something.
Modified approval on this one. Highly.
No business. Anybody got any new business? Anybody want to go home?
Move the adjourn.
All in favor, say aye.